Let us start the first question from theory, November 2009, question number 5I. So November 2009, question number 5I. Explain briefly the limitations of financial ratios. So the question says that you are required to explain the limitation of the financial ratios. Let us have a discussion first of all before we proceed for the answer. So we understand that the limitation of the financial ratios are like this. First of all, we will have a small discussion before we read the answer of the institute. The first is ratios are calculated based on the accounting details, and there is a criticism for the accounting details that it is like easily you can manipulate it. How can you manipulate it? You can manipulate it like this, that you change your accounting assumption, with that your profit will change. You change your accounting policy, with that your results will change. So as per your requirement, you can easily manipulate it. That is what's the first limitation that the ratios have. Second limitation is that it is ignoring the impact of the inflation. We know that the accounts are returned based on the historical values. So if at all a company has purchased a land and building, let us say that is purchased the land before 20 years. Right now in the books of accounts, it is shown at the purchase price originally. Yet today the value of the land is substantially more. So that effect is ignored when we are considering we understand that the accounts is representing the financial position. It may happen that the value of that land has substantially gone up. So effect of the inflation is ignored. We compute the depreciation on the historical WDV. Now if at all a plant and machinery which was purchased, let us say that 6 years ago, the current price of that plant and building, that is a plant and machinery, has substantially increased. So whatever the purpose that we have of claiming depreciation or writing depreciation is not served, if at all we are doing like this. That is the limitation that we have. Third, we understand that there is a scope of the window dressing. Suppose, let us say that right now it is the February 2021 going on. Let us say, I know that in the next year, that is in the year 2021 and 22, I am going to take a loan. For the purpose of taking loan, let us say that I am going to approach to a bank. I know the very first thing that the bank is going to ask is about my debt equity ratio. They will see that whether my debt equity ratio is low or high. If it is high, then in that case the chances for me to get the loan decreases, and vice versa. So what I will do, even though right now in the month of February I have the debt financing in my business, I will do some adjustments, because of which when it comes to the March end, I will be able to reduce the debt financing. With that, the debt equity ratio is reduced and I will be able to get a loan. So even though that is actually my financial position is not so strong that I should be getting the loan, yet this kind of window dressing is possible. I know that if at all I am going to approach to my supplier for the purpose of purchasing goods on credit. Then in that case, my supplier is going to calculate the current ratio. So again year end I will do certain adjustments, because of which my current ratio is high. These kind of adjustments are possible, and with that we will be able to do something which is favorable to us. And this is what we understand is the window dressing. So ratio analysis is not useful, or ratios can be easily manipulated like this. Fourth, we understand that, say, if at all there is a company which is having, let us say that's the business of electronic line, at the same time say it is dealing in the chemicals. Suppose it is doing two diverse business. Now, if at all there is a combined result of this company, then ultimately it is not going to make a sense. Why? Because see, you cannot make a comparison of say the financial results of this company with anyone, because it is having say the mixture of two. This is what's the kind of limitation of the ratios, because the financial values are say pertaining to say this two line of the business which are different. Next, we understand that, say, as far as the ratios are concerned, the ratios are not so much helpful in a situation wherein it happens like this. Listen carefully what I am going to speak. That when you try to evaluate a ratio separately, it is not going to make a sense. For example, if at all you are just considering the stock turnover ratio, so stock turnover ratio is a ratio which is indicating that, say, how fast the rotation takes place of the inventory. If at all the stock turnover ratio is high, it is indicating that, say, the company is able to get the turnover fast. And if it is low, then in that case it is indicating that the company is not able to get the movement fast. But at the same time, we are required to see the debtors turnover ratio. We are required to see that, say, what is other working capital item. That is the way we are required to consider all these things together. We cannot just take into account the stock turnover ratio for the purpose of evaluation of the working capital management. When we are looking for the, let us say, the liquidity ratio, then in that case, say the current ratio is high and liquidity ratio is low, then in that case it is indicating that, say, the stock level is high. Like that, so you are required to take into account like all these ratios together. There are certain ratios like this, that is considered as a return on capital employed and a return on equity. Then return on capital employed, along with that, so the cost of debt financing, cost of preferential capital financing, that we are going to study in the chapter of cost of capital, and with that return on equity. When you will take into account all these ratios together, only in that case you will be able to exactly know the impact of any of the ratio, that whether this ratio is favorable to the company or not. So you require the overall picture, say, for the purpose of ratio analysis understanding, and we should not see any of the ratio in isolation. Next important point is, there is no standard as such. We understand that, say, like we already have discussed this point, that high current ratio is indicating that the liquidity position is sound. At the same time, it is indicating that, so the company is having unnecessarily made investment in the working capital. Like that, so there are two things that say that go hand on hand. One, that it is indicating that, so the working capital is high. That shows that the liquidity position is strong. But unfortunately, it is also indicating that, say, we have kept more amount of investment in the working capital, which is not a good sign. This is the way, say, we understand that, say, basically the ratios are not having any as such, say, the standard. Let us read the answer which they have provided. Limitation of the financial ratios. This is absolutely an answer of the instituted publication. I have not done any alteration in this. We are very happy to hear or to read this. Students are required to write any four limitations. So institute is kind enough to ask only for the four limitations. So let us read the head points first of all. Diversified product lines, that is more than one businesses. Inflation, seasonal factors, window dressing, year-end adjustments, accounting policy and accounting period is different. No standard set of the ratios. Difficult to generalize whether a particular ratio is good or bad. It is interrelated and not independent. These are the head points. My suggestion to all of you is this. Listen carefully. That for this head points you should prepare a separate note. And whenever you get a time, maybe while you are having lunch, you are having dinner, you are having breakfast, and if at all some time is there, you can just refer to these head points on the regular basis. Number of times, if at all you are that is say from your home to class you are going via bus or something like that, in that case also you can use these notes for the purpose of revision. At the same time, you can prepare your own audio, say for these questions and head points, and you may listen it on the regular basis. This is the way we can use, say, certain like the phone or something like that, say for the purpose of revision. This is my suggestion to all of you. Diversify product lines. Many businesses operate in the large number of the divisions in quite different industries. In such cases, ratios calculated on the basis of aggregate data cannot be used for inter-firm comparison. Financial data are badly distorted by inflation. Historical that is cost values may be substantially different from the true values. Such distortion of the financial data are carried out in financial ratios. Seasonal factors may influence the financial data. This is what I think which is important limitation. To give a good shape to popularly used financial ratios like current ratio, like debt equity ratio, the business may make some year-end adjustments. Such window dressing can change the character of the financial ratio, which would be different had there been no such year-end adjustments. Difference in accounting policies and accounting period. It can make the accounting data of the two firms non-comparable, as also the accounting ratios. There is no standard set of the ratios against which a firm's ratio can be compared. Sometimes a firm's ratios are compared with the industry average, but if a firm desires to be above average, then the industry becomes low standard. On the other hand, a below average firm, industry average becomes too high as a standard to achieve. I would say, friends, that in this case, that say any of the ratio which is near to the industry is considered to be a fair ratio. That is, it is very difficult to generalize whether a particular ratio is good or bad. For example, a low current ratio may said to be bad from the point of view of low liquidity, but high current ratio may not be good, as this may result from the inefficient working capital management. Financial ratios are interrelated and not independent. Viewed in isolation, one ratio might highlight efficiency, but when considered as a set of the ratio, they may speak differently. Such interdependence among the ratios can be taken care through multivariate analysis. Friends, this question was asked for 2 marks and they are expecting, say, the 4 limitations. So we understand that, say, this is what, so the half mark for one that is the correct limitation that you mentioned. Usually we have, like in examination, the theory questions maybe of 2 marks, maybe of 3 marks, maybe of 4 marks. So accordingly you are required to adjust the answer. Next, second question from May 2011.